We're going to bring in the head of tech equity research at Standard & Poor's. That is Scott Kessler. He has been following internet stocks for over a decade. Also with us, our in-house tech experts, Bloomberg West editor-at-large, Cory Johnson, normally in California. Today he's in Chicago. Scott, we're going to start with you. If Groupon can hold on to some of today's gains, what does this mean for other companies thinking about going public? I mean, does it indicate that the tech IPO market can come back?
Well, Deirdre, it's great to be with you. I think Groupon, while it's been a lightning rod per se in terms of comments and criticism, I don't know if it's necessarily a measuring stick in terms of over one day gauging if and how internet companies are going to consider coming public at this point. Nonetheless, it's encouraging because we really have not seen a lot of significant internet companies coming public en masse for a long, long time.
And Cory, I want to bring you in here from Chicago because we know the company had a very long and sometimes twisted path to where it got to today, right? I mean, the company has this rough valuation, $12.7 billion, but that was a little bit below that $15 to $20 billion. I know you were reporting a lot about that a few months ago. Still concerns, right, about Groupon's core business?
Right. I mean, these guys wanted to go out at 25 to 30 billion, and who wouldn't? But think about the bumpy road that they went through, rejecting a deal from Yahoo at about $3.5 billion, rejecting a $6 billion deal from Groupon. But at this valuation of $12 billion today, you have behind me some people that have made a considerable amount of money on paper, but won't be able to get out of those shares for probably 180 days. You wonder what the valuation will be then. This deal was so widely criticized. 2 chief operating officers quitting within 6 months. Restatements, not just of the revenues being cut by about 42%, but also restating the way they calculated prior periods, these massive marketing costs when they slowed down the marketing spend, the business slowed down. So we still don't know what Groupon is going to be weeks from now, let alone 180 days from now when those people in the Groupon building behind me can start to cash in on some of that money.
Cory, I'm glad you brought us that context there. And Scott, I want to put this back to you because Cory just said, too early to tell. And I want to go back, if we can, to some of the other deals that we heard about earlier in the year, right? Pandora, right now, trading at its IPO price. I think we even have some charts for our viewers, but it's down 13% from where it closed on day one. LinkedIn, 70% up from its IPO price, but down from where it closed on day one. And now we have Groupon. So what does this mean for the bankers gearing up? I mean, there's about a dozen IPOs that are supposed to be coming this month alone. Are they going to happen?
Well, Deirdre, I think the market, to a large extent, is stabilized. And frankly, there are a lot of companies that seemingly want to come public. It used to be 10 years ago that companies would come public really for 2 primary reasons, right? They wanted some additional capital to make investments, and they wanted liquidity for their investors and insiders. Now there are other options, let's say, for companies at this point. So to some extent, you've seen a lot of internet companies delaying, putting off at all possible coming public. We think that from now until this time next year, you're going to see a lot of internet companies at least approaching the prospect of coming public. And we think that's probably a good thing, not only for them, but for the markets as a whole.
Cory, what do you make of Groupon's bankers really tapping demand for the offering, right? I mean, they've only offered about 5.5%, right, of what was available. And we know there's another 4.5% that's supposed to come. How is this going to affect, if at all, how Groupon trades?
Well, look, I think this is a really deeply cynical thing. I mean, the bankers behind this deal, Morgan Stanley and Goldman Sachs on the left, the lead bankers in this deal, Morgan Stanley, the book runner, they've orchestrated this thing to try to get suckers to buy the stock on the first day by putting out so few shares. Now, Groupon had to do that because the deal was so widely criticized. And on one hand, if Morgan Stanley can get this thing public, they can get anything public because this deal was so widely criticized because the company doesn't make money, and it isn't clear that they ever will. But I think that for the market to react this way to this stock, it seems like it's a rigged deal, and I wonder how people will react to this thing if it doesn't hold the IPO price, and how investors writ large will approach the market and future IPOs.
Hey, Scott, what do you make of what Cory just said? As he just reminded us, Groupon is still not profitable. Their core businesses are struggling. What does that mean for the integrity of the whole tech sector, the integrity of bringing tech companies public?
Well, look, first of all, people have been talking about this technology stock bubble for I don't know, a year or so. And to us, we don't know what people are looking at. Maybe there are a handful of companies where valuations could be construed as excessive. But I mean, if you look at the bellwether companies out there, we like a lot of them. And it's not just because of the fundamentals. We think the valuations are not only attractive, but in certain areas of technology, historically compelling. So Groupon here, I don't know if it's necessarily going to be a signal, but it's going to show people, to Cory's point, given the criticism, given the concerns, the company came public, they raised their money, and the stock so far is doing okay. The question is, when you see additional liquidity, when you see now people able to comment on the company more broadly as analysts, then what's going to happen? And that really is the big, I think, kind of wild card, along with, of course, how Groupon does from an operational perspective. That's key as well.
Cory, you're not even in New York, but I have to bring back the cynical card, even though you live in happy, sunny California. What are the chances that investors bought into Groupon because they just wanted to be part of this next generation, so to speak, of tech companies? There's not a lot of choices out there. And so if you want to be involved, Groupon was just the best bet to go with for timing reasons.
Well, there are a lot of choices out there. There are hundreds. I think there are over 500 technology companies with market caps north of $500 million. To Scott's point that there aren't bubbles out there. I mean, look at the valuations placed on companies like Amazon, or what we saw until recently with Netflix, or until recently with OpenTable. We've seen some of these stocks that are with really high PEs. On the other hand, you can see companies like Alcatel-Lucid, which have tiny valuations, or growing companies like Google and Apple, whose price-to-earnings ratio, price-to-earnings growth is much lower. So there are some great companies out there. There are some crummy companies out there. And there are some better companies coming public. I mean, we got the updated filing from Zynga today. This is a really terrific business that is, I'm not talking about valuation here, but they're growing really fast. Their growth is continuing to be strong, unlike Groupon. They're throwing off tons of free cash flow, which is the ultimate measure of a successful business. So there are lots of choices out there for investors. They don't have to run and chase the latest IPO.
All right, well, we thank you very much. Both Cory Johnson standing by right in front of Groupon headquarters in Chicago. Scott Kessler joining us from Standard & Poor's from right here in New York. We're going to